The prices of the things we need to live, food, fuel, housing, pretty much everything, have suddenly exploded higher this year. Are we about to see the return of crushing inflation like we suffered through in the 1970s? Well, we invited Lacy Hunt, one of the world's top experts on the inflation-deflation debate, to speak at the recent Wealthion conference held in early June. And he made a very compelling argument that the spike we're seeing in inflation today will likely be short-lived and that deflation remains the bigger threat. If you missed the conference, you're in luck because we're going to share that very important presentation with you now. So keep watching.
I do believe that we are in the peak of inflationary pressures in the vicinity, and that we're also in the vicinity of the peak for economic growth.
Dr. Hunt is an internationally known and award-winning economist. He's currently the executive vice president of Hoisington Investment Management Company, a firm that manages over $5 billion in assets for pension funds, endowments, insurance companies, and others. Previously, he was chief U.S. economist for the HSBC Group, one of the world's largest banks. Before that, he was the executive vice president and chief economist at Fidelity Bank and the vice president for monetary economics at Chase Econometrics Associates, Inc. He also has served as a senior economist for the Federal Reserve Bank of Dallas. Just an unbelievably accomplished gentleman. Lacy, thank you so much for joining us today.
My pleasure, Adam. Great pleasure.
Well, thank you. Well, Lacy, you are known amongst many other things as really being sort of a, you tell me if this is fair or not, but sort of a dyed-in-the-wool deflationist. And we are now moving into a period, we'll see how long-lived it's going to be, of rising inflation. Is this going to be as transitory as the Fed would like us to believe? Look, I know you're about to walk us through a presentation, but I'm just very curious to see what your outlook is on this whole inflation-deflation debate, because that seems to be just sort of an existential question that investors need to try to answer right now.
Well, it should be answered. I do believe that we are in the peak of inflationary pressures in the vicinity, and that we're also in the vicinity of the peak for economic growth, and that cyclical forces, structural forces, and even monetary forces are going to be leading to a deceleration in both growth and inflation as we move forward.
All right. Well, look, I know you put together quite a detailed presentation for us, so let's dive right into that.
Okay, great. Let's start with page one. First of all, I'm going to look at the cyclical forces that support my forecast. This is on the far right-hand corner of the chart. I've given the projection of the OECD for real per capita growth. Will be 6.2% this year. A very on the far right-hand corner, right-hand side there. Which would be the fastest growth rate since probably 1959. Very strong growth. However, notice that comes after the largest decline that we've witnessed since the demobilization at the end of World War II. Before we leave this chart, I want to point out a couple of longer-term trends that are in the upper right-hand corner. From 1870 through 1997, which was a very pivotal date, the standard of living grew 2.2%. 1997 is very pivotal because that's when a variety of econometric studies in both the US and Europe indicated that the debt levels were so heavy in the US and in other major areas of the world that it was having a deleterious impact on growth. Since then, our growth rate has only been 1.2% per annum. And that has a real importance for individuals, as shown in the lower right-hand corner. If we had managed to maintain the long-term trend growth over the post-1997 period, the per capita GDP at the end of last year would have been 25% higher. Now, when one sees a sharp rebound in growth after a deep recession, the normal relationship between economic activity and inflation and interest rates doesn't hold other than for limited periods of time. And one of the reasons is that recessions cause a lot of broken windows, which leads to the fallacy of the broken window. Businesses fail. Firms go out of businesses. A lot of facilities are no longer really usable. And so when the economy recovers, we pick up the rebound in spending, but we don't subtract out the losses. Let's go to page number 2. The inflation rate is clearly a lagging indicator, and it has been since the early cycle dating work of Arthur Burns and Wesley Clare Mitchell. Looking at line number 5 of this chart, between the start of the recession and the low point in inflation, the lag time is almost 15 quarters. Now, there were a couple of shorter episodes after the 01 and 09 recession, 6 and 7 quarters, but that was the technical low. Even 2-4 years later, the inflation rate was just barely above that cyclical trough. Now, there's a reason why inflation is a lagging indicator. If an economy comes out of a recession and inflation rises, then basically the recovery will not be able to maintain traction, because in inflation's prices rise faster than wages, and that ultimately will lead to weaker consumer spending. In addition, the higher inflation causes the US to import more goods. Higher trade deficits subtracts from economic activity. And of course, the higher inflation leads to higher interest rates, and that turns the credit sensitive sectors down. Let's go to the next chart. One of the reasons that inflation lags is that in the early stages of recovery, there is a huge gain in productivity. And there's a corollary to that, in that the gain in productivity is very sharp after sharp recessions. So on this chart, we're looking at what happened to productivity after the 3 deepest downturns since 1948, one in 49, 58, and 82. And look at the third column on line number 7. The average rebound in productivity was 5%. As a matter of fact, productivity in the last year is up 4%, and wage costs are rising less than 4%. Now, we do have a number of supply side disruptions. When the pandemic hit, the low-cost producers in Asia were not able to ship their goods into the United States. And as a result, the relatively high-cost producers in the US were able to gain market share at the expense of the low-cost producers in Asia. In fact, the pandemic did more for American producers than the Trump tariffs of a couple of years earlier. Now that the ports are opening up, the lower cost goods from Asia and elsewhere around the world will be coming in to the US. And these foreign producers are going to want to gain market share. And the recently enriched domestic producers are going to want to try to hold market share. So as time goes by and as the bottlenecks are ending, then we're going to see price wars. So the inflation is very tense now, but my view is that it will not hold. And in addition to that, the events of 2020, I think, have had an additional non-cyclical influence on productivity. They say that necessity is the mother of invention. And when crises occur, whether it's a war or economic downturn or pandemic, technological change that would have occurred 2 or 3 or 5 years later are pulled forward in time. And so I think that ultimately the gain in productivity will be very strong, and we'll see sustaining changes from the new technologies that have arisen. Another factor that also ultimately points to lower inflation after we work through these difficulties is on the next page. We have substantial amounts of people that are no longer working. And that means that on balance, we've got a lot of productive people that can be pulled into the labor force. And that's also a cyclical element. Let's go to the next chart. Now I want to look at the structural factors that are indicating that growth and inflation are close to their highs for the year. What you're looking at on this chart is total global debt, public and private, as a percent of GDP. And we jumped to more than 280%. It was the largest increase in debt for any single year or any multi-year combination you want to put together. Notice how much larger it was than in 2009. The comparisons are in the upper left-hand corner. Now, when there is a huge surge in debt that is facilitated by central bank operations, this tends to shift the aggregate demand curve upward and outward. And when supply side disruptions are shifting the aggregate supply curve inward, you get transitory inflation. And the reason that it's transitory is that when prices rise, the law of supply takes over, and producers are encouraged to produce more. And in addition, the aggregate demand curve, and when we undertake these big debt financed operations, starts shifting back to where it was. And the process that's at work here is that when debt increases very rapidly and it's at high levels, it triggers the law of diminishing returns. And this pulls down the marginal revenue product of debt. And this then leads to a decline in the velocity of money. And so as time goes by, supply will increase and demand will weaken. Now, this is just an overview. I'm going to take you through the detailed steps as we proceed forward. Let's go on to the next chart. One of the most important confirmations that debt has this deleterious effect that we see in the United States is that this influence is clearly apparent when we compare the debt levels in the US versus our major trading partners in Europe and Japan. And what you're looking at here is total debt. The US is currently at just under 400%. The Euro area is 100 percentage points of GDP higher, and there's Japan at 675%. Now, if debt, it does have this negative influence, we should be able to see it in terms of what's happening to the relative economic growth, and in fact, we do. And let's go to the next chart. In this chart, what we did, we took the ratio of US GDP, real GDP, to European, that's the black line, and the blue line is the US relative to Japan. Now, I started the graph in 1995 because that's the first year of the Euro currency zone. And at that point in time, the US was 4% larger than Europe and 98% larger than Japan. And we're now more than 34% larger than Europe and 200% larger than Japan. So the adverse consequences of the debt is not only apparent in the US aggregate figures, but in the relative performance of the US versus Europe. Let's go to the next chart. Since the founding of the United States, we've actually had 5 debt bubble peaks, and they're listed there. The first was in 1938. That was building the canals, the early steamship lines, railroads. There was overinvestment. We don't know what the level was. We have to rely on anecdotal evidence. The second one was in 1873, 35 years later. That was associated with the railroads and the industries that fed the railroads. There was also over-speculation, over-investment. The 1920s and 30s, well-known case. Then 2008, 2004, which most people have a firsthand familiarity with. And then we set a new peak in 2020. Now, what's important on this graph are 2 things. First of all, in all of the 5 previous cases where the outcome is known, we had disinflation. But in 3 of the cases, we have a special case of disinflation, which is where the price level actually pierced the zero bound. The other important consideration is on line number 6. These debt bubbles have typically been very long apart, by an average of 46 years. But the peak in 2020 is just 12 years after the one in 08 and 09. Let's go to the next chart. Another structural factor is that demographics are not only negative in the United States, they're negative in all of our major trading partners and increasingly negative for the global economy. Last year, the world's population had its slowest percentage increase since the 1950s. Notice what's happened to the US, column number 1. We've dropped from over 1%, 1.2% is the long-term average. We're down at 0.35. Japan is negative. By the way, before the Japan started on this debt trek in the late 1980s, they had very vibrant population, close to 1% per annum. Now they're declining. The Euro population growth is weaker than the US, and China last year was unchanged. So let's now look at the birth rate in the US versus Europe versus China. I indexed these 2 series at 1 in 1949 because they're in slightly different computational basis. But notice the decline in both areas, but the far more precipitous decline in China than the United States. It's less than a third of what we're doing. Now, the Chinese problem is a result of the fact that they had a prolonged period, 1 child per family. They have a tremendous mismatch between young women and young men. The average age in China is over 40 years. In the United States, it's only 38 years. Every 12 months, the Chinese average age is going up by 6 months. So in a year from now, the Chinese average population age will be 41 years. And the average age in Europe is greater than in China, and the average age in Japan is the highest of all. Now, I could give you more statistics, but let me tell you why demographics have such a negative economic impact. There's a popular book out presently that makes the contention that the demographics mean fewer people and that we're going to see higher wage pressures, and that will lead to higher prices. And certainly, if you have fewer bodies, all else being equal, this would lead to higher prices. However, there is the historical experience. In Japan, the disinflationary forces with the worst demographics are more serious than in Europe. And in Europe, they're more serious than in the United States. Now, why do negative demographics adversely affect growth? And the answer is through the impact on investment, household investment, business investment, and even governmental investment. Think of the expense of bringing babies into the world and raising them, educating them. Think of what business firms have to do in order to supply goods and material to the needs of growing families. And even think of the needs of state and local governments. They have to expand educational facilities and other things, need more subdivisions, water and sewer. So when countries are beset by negative demographics, this tends to have a profound deflationary influence. Folks like to call the 20s the Roaring 20s, drawing the reference to the 1920s. However, until very late in the 1920s and continuing into the 1930s, we had very robust demographics. It was only after the economy collapsed that the demographics turned negative. And as I've said, we have more modern cases in Japan, in Europe, and we'll soon see cases in China. Let's go to the next chart. The next reason that I believe that the inflation will not persist is because, in spite of certain aspects of monetary policy that we're all aware of, the fact that there's been a big surge in the money supply and the Fed is buying $120 billion of Treasury and agency paper every month, the monetary policy is not expansionary. It's actually contractionary in aggregate. Now, the way I view monetary policy is I believe that it has four main components: the price effect, the relationship with the banks, the quantity effects, and then the velocity of money. And we're going to look at each of those in turn. Now, first of all, let's start with the price variable of monetary policy, which is the policy rate. Now, to economists, the price variable is very important. We believe, and there is great evidence to support this, that what motivates people most directly is price incentives or disincentives. And the critical Federal Reserve variable in this regard is the policy rate. Now let's study the graph for a moment. What you're looking at is the policy rate since 1944, when the Treasury rate started floating freely, through the present. The red circles are the level of the policy rate at the start of the recession, and the blue dots are the cyclical low. Now, look in the upper left-hand corner for just a minute. And Adam, if you'd put the cursor up there, upper right-hand corner. The average lag between the start of the recession and the cyclical trough is 38 months. That's a long time. Now also notice the gap between the red dot, the red circle, and the blue square. And notice that there's a big difference. In other words, not only does the federal funds rate decline long into the expansion, but there is historically a drop of several hundred basis points, or often even more. And in the current situation, the policy rate is at the zero bound. And the Federal Reserve is saying that they're not going to allow the policy rate to push through the zero bound. And in fact, they're doing almost $500 billion of reverse repurchase agreements right now to hold the zero bound in the face of the heavy buying of government and agency securities. So what this means to me is that the price variable of monetary policy is not operative. Let's look at the second component of monetary policy, the relationship with the banks, on the next chart. Now, the most critical variable here, in my view, and I'm going to show you a little bit of econometric evidence in just a minute, is the loan to deposit ratio of all banks. The red dot, once again, is where the loan to deposit ratio is at the start of the recession. And the blue square is the low point. Go to the upper right-hand corner. And as you can see, the lag time again is 47 months. And also there is a rather significant decline in the loan to deposit ratio. And already the loan to deposit ratio has dropped to a new cyclical low. Now, this confounds a lot of folks, because in their macroeconomic textbooks, they were taught that if the Fed increases reserves, this is a hot potato. I was taught that phrase. And the banks will lend the reserves out. And the funds will flow into the private sector, and that will enhance the expansion. However, that model is basically flawed. If banks do not have excess reserves, they cannot lend. But simply having reserves is not a sufficient condition to lend, because the banks have to price through all of their costs. The cost of money, which is trivial. There are other overhead costs, but they have to price through the risk premium. And the risk premium is the risk that the loan will not be paid off. And what's happening right now, as it always does happen in early stage recoveries because of the cyclical rise in debt, which is now much more than that, it's a structural rise in debt, the risk premium rises. And so as the Fed is injecting reserves into the banking system, this does not alleviate the need for the banks to charge an ever higher percentage that the loan may default. Let's go to the next chart. The top panel are the loans of all the commercial banks. And regardless of whether you measure them short-term or long-term, they're contracting. The bottom panel are the deposits, and they're growing in the 15 to 25% range. So the Fed has been able to engineer an increase in deposits, but the loans are faltering. And so the drop in the loan to deposit ratio is a result of what's happening to both the numerator and the denominator of the loan to deposit ratio. Let's go to the next chart. Now the money supply, the principal variable, are the other deposits of the commercial banks. And last year, M2, as has been pointed out by numerous people, increased 25%, the largest increase since 1943. And on a shorter term basis, the growth rate in the inset chart is still up around 20%. It's still growing very, very rapidly. Now, many people remember the famous dictum of the Nobel laureate Milton Friedman, who said that inflation is always and everywhere a monetary phenomenon. However, in the algebra of that famous paper, he made the assumption that the velocity of money is stable. He was using the model, the equation of exchange, developed by Irving Fisher, which says that nominal GDP equals money times velocity. And let's look at velocity on the next chart. First of all, the equation they're written at the top of the chart. Money times velocity equals GDP. Now, if velocity is relatively stable, which Friedman assumed, and money supply growth is 10, then nominal GDP growth is 10. Now, draw your attention, first of all, to the time period from the early 50s to the early 80s. And during that time period in which Professor Friedman was writing and doing his research, the velocity of money was not constant, but it was relatively stable. In the 1970s, the great inflationary era, money supply increased 10, velocity was stable, and nominal GDP increased 10. Look at the whole chart and notice how volatile velocity is. Now, it's kind of ironic, but Friedman is using Irving Fisher's format. And he called Fisher America's greatest economist. However, Fisher never believed velocity was stable, even though he did not have the data that you're looking at here. In fact, this data we were only capable of creating it due to historical and archival research that was completed in the late 1980s. So in 1997, when the economy reached this dead inflection point, every dollar of money, M2, was leading to $2.20 of GDP. Notice what's happened since then. As the economy became more indebted, the velocity of money has fallen not every month, not every quarter, but it's dropped to $1.20. It's back in the vicinity of the lows that were reached in the 1940s. Now, I want you to look at the 1900s and teens. We started a big buildup of debt. Debt actually peaked in 1918. And $1 of money led to $2 increase in GDP. We took on even more debt in the 1920s, but notice the velocity of money was falling, just as it was falling after 1997. What you're witnessing here is the law of diminishing returns. When economies overuse a factor of production, such as debt capital, initially the GDP rises. But if you continue to overuse that factor of production, the GDP flattens out and then it turns down. And that's the problem today. We're overusing debt capital. But we can take this analysis even further, as we do on the next chart. What I'm now going to do is show you what I believe are the two most critical determinants of velocity. Now, this does not mean that I believe these are the only factors that influence velocity. Velocity is a very complex variable, just as is GDP. And there are a great many elements that come and go. On the chart in front of you, the blue line is velocity. I indexed it to 1 in 1959. And I indexed the loan to deposit ratio at 1 also. And notice the very strong correlation between the blue line and the black line. In fact, the adjusted R square is in the upper left-hand corner. Very strong correlation. Now let's go to the next chart. Here I have repeated this same exercise, but I have replaced the loan to deposit ratio with the marginal revenue product of debt. Now, to just explain this, that's the amount of GDP that is created per dollar of debt. For example, back in that relatively flat period, in the 50s, 60s, and early 70s, every dollar of public and private debt was creating about 70 cents of GDP. And now we've dropped below 30 cents. Let's take this analysis one step further on the next chart. What we did here is we related the velocity of money to the marginal revenue product of debt and the loan to deposit ratio, and I gave each of these variables a 50% weighting. So velocity rises when the efficiency of debt increases, and velocity rises when the banks increase the percentage of their deposits that are going to loans to the private sector. And if the loan to deposit ratio and the marginal revenue product are declining, then the case is very strong that the velocity of money will continue trending downward. Now, I'm just going to give you a couple of little pieces of additional information here. On an earlier chart, we showed that M2 velocity was 1.2 in the US. In Europe, which is far more indebted than in the US, velocity is turning over less than 1. In fact, the latest numbers are 0.85. And in Japan, velocity is only 0.5. So not only do we see the strong correlation between velocity and marginal revenue product of debt in the US, but it is confirmed globally as well. Let's go to the next chart. Now, the practical importance of a big increase in money supply and a decline in velocity is that the liquidity is trapped in the financial markets. And we see a lot of evidence of this. The Fed creates deposits, except for very short intervals. The deposits do not move into the economy. They remain in the financial markets. This leads it to an increase in financial asset prices and a decline in the rate of return on financial assets. But what you're looking at on the chart in front of you is some first-rate thinking from a Nobel laureate that provides another causal mechanism of what the Fed is doing and how it has this impact on financial assets rather than real assets. The research that you're seeing was conducted by the Nobel laureate Michael Spence, who received the Nobel Prize in 2001, longtime dean of the School of Business at Stanford, working with Kevin Walsh, former governor of the Federal Reserve Board. And here is their point. When the Fed engages in quantitative easing repeatedly, they give a signal to the corporate managers that financial asset prices and financial liquidity is protected. But the Fed cannot protect the prices and liquidity of real assets. And so this causes a greater and greater share of corporate resources to be channeled into the financial markets rather than into the real economy. And over time, this undermines economic growth. Let's go to the next chart. This is one of the most important relationships in economics. It shows you the components of net national saving and the important relationship between physical investment and saving. I draw your attention to the equation just there to the right of the note. Let's put it on the I variable, Adam. Okay. That I is physical investment, plant, equipment, technology. It must equal saving in the total sense of the word, which is composed of private, government, and foreign. Now, first of all, look at the dashed line. Since 1929, we don't have the data prior to then, net national saving was 6.3% of national income, which means that physical investment was also 6.3. Last year, we had a very sharp decline. The green line, it was under 2% last year. In fact, close, not that far above zero, far below the long-term average. We only had 2 episodes of net national saving being lower, 08-09, and then the 1930s. Now, the gray shaded area, show them the, that's right, surged last year. However, the government dissaving, the red line, was at a record, at almost minus 15%, which took out the historic lows during World War II. And so the net result is that we do not have the physical saving out of income to finance investment. Now, I want to compare and contrast our current situation with what happened during World War II. So go back and Adam, put your cursor on the red line. So we ran a deficit of 14%, but notice how large the gray shaded area is. It was more than 25% of net national saving. Many people think, including Keynes, that what healed the economy and allowed for the was the deficit spending of World War II. However, World War II also cured the indebtedness problem because we had mandatory rationing. We paid off the debt of the 1920s and 1930s. So the large budget deficit that we incurred last year is in no way, shape, or form similar to the deficit that we ran during World War II. Let's go to the next chart. What you're looking at here are your real after-tax profits. The inflation adjustment's not that important. These are from the national accounts. These numbers come from the IRS. The beauty of the numbers is that in 2020, there are no addendum items or special factors. And nor are there any special factors in 1948. In other words, the computation is the same. And so we've had a very subpar growth, and the net result is that your corporate profits have basically been stagnant since 2008. If you include the numbers that were just released for the first quarter, they indicate that the figures this year will be unchanged from 2017, a long time. Now, we know that some firms have done extremely well, but that implies that a lot of small and medium-sized firms have not done well. The financial markets have done well, but the generation of profits to produce longer-term economic growth has been lacking. Let's go to the next chart, which is my final one, and which is sort of a summary of the various points that I've been making. This is your long-term Treasury bond yield since 1954. Before that, remember, the rates were pegged. So this is a freely floating period. The red dot, once again, is where the bond yield is when the recession ends, and the blue dot is at the low. Look in the upper right-hand corner. The average lag time since 19 54 is almost 50 months. But if we focus on just the highly indebted phase, or since 1990, the lag time is 76 months. And it goes back to the important Fisher equation, which says the bond yield is equal to the real rate plus inflationary expectations. Now, in conclusion, I want to talk about how the world ends. There's the general theory out there that the debt must have some sort of tipping point, and that the whole system will sort of blow up. That's not what I think is likely path. To provide an answer, or to start to provide an answer, I'm going to quote from the poet T.S. Eliot in his famous poem, The Hollow Men. And at the end of that poem, he asks, how does the world end? How does the world end? And he says, it ends not with a bang, but with a whimper. In other words, if we go along the high debt path, what we're going to experience is debt by slow strangulation. Now, I cannot leave it there because the framework that we're operating under today with regard to the central bank may change. When the Federal Reserve was set up after we left the gold standard in 1934, the objective was to give the Federal Reserve great powers, but not to allow the central bank to become a banana republic bank. And so the Federal Reserve can increase their liabilities in an unlimited amount, but those liabilities are not legal tender. To be legal tender or money, something must be a medium of exchange, a store of value, and unit of account. The Fed's liabilities remain on the books of the Fed. They can lead to a first round increase in money supply, but not second and third round increases unless the banks cooperate and the marginal revenue product of the debt rises. But so the Federal Reserve System was set up to make the Fed the lender of last resort, not the spender of last resort. But there are at present advocates for making the Federal Reserve's liabilities medium of exchange or legal tender. If that were to happen, then inflation would begin to rise very, very rapidly. Something called Gresham's Law would be triggered. The bad money would chase out the good money. In other words, if the Federal Reserve Act is amended, then we would have to modify T.S. Eliot's ending of the world. In that case, it would end with a bang. That concludes my remarks, Adam.
We hope you've enjoyed this graduate level presentation by revered economist Dr. Lacy Hunt. At our conference, Lacy was gracious enough to field 20 minutes of audience Q&A following this presentation. And it was just as hugely valuable and enlightening as all of the charts and data that you just saw. To watch a free video of that Q&A session with Lacy, just go to wealthion.com/Lacy. Thanks for watching.